My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour, Francis Coppola, who's got a phenomenal following here on Twitter. Has been a great commentator on markets. I think it should be a good conversation here. Francis, for those who are not familiar with your background, talk about who you are, how'd you get involved in looking at markets, and what are you doing now?
Well, I worked in banks for a long time, like 17 years of it, and I did an MBA in finance and economics and stuff a long time ago. And then I gave it all up to be a singer. And then the financial crisis happened, and I joined Twitter. Yeah, when I got into Twitter, everybody was talking about banks. And most people were talking rubbish about banks. So I kept going. So I started saying, well, it doesn't really work like that. And the rest is history, really.
I'm curious, what genre of music are you a singer in?
Classical.
Classical.
Yeah, absolutely. It's actually my first love. I was a singer first. I went to a long time ago. I studied at the UK's Royal College of Music as a singer. And yeah, I did actually have a bit of a career as a singer, and I still teach and sing professionally a bit.
I've always argued that looking at markets is in some ways similar to being a songwriter or singing or playing music in general, just because there's certain progressions, there's certain rhythms, there's certain tones to the market as there are with songs. And I think that the part of the brain that gets activated by music, maybe that tells you a little bit about economic action or market sentiment in some ways, which we'll talk about here. But let's get into things a little bit. So I know you've been a critic of cryptocurrencies. I have been a critic of cryptocurrencies from the standpoint of narratives. I simply can't stand narratives. I think most people are very confident in how they tell a story after the fact, and that doesn't really tell you anything about the future. We've had a pretty big meltdown in the space, and every single time I turn on the media, they talk about how this is like the great financial crisis for cryptocurrencies, that there's a crypto winter, and ironically, they're doing that now as a new narrative, as cryptocurrencies seemingly are now rallying, which I think is kind of amusing. I'd like to lay out how you think this played out in the last several months, what do you think is likely to come, and if this meltdown may actually be either earlier or over.
Well, what we've seen really is the bursting of a leverage bubble. The whole space was completely over-leveraged, and I don't think too many people would disagree with me about that. And think about when you have a whole leveraged house of cards built on top of a relatively small quantity of money, really. It's not surprising that eventually the party comes to an end and the whole thing collapses. And that's really what we've seen. We had a specific event that was the trigger for this collapse, really, which was the collapse of Terra Luna back in May. But in fact, Bitcoin, cryptocurrencies and so forth had been falling since last November. But, so people have compared Terra Luna's fall to variously Bear Stearns, Lehman Brothers, LTCM. I look at it as it's actually a little bit more like the failure of Knickerbocker Trust back in 1907. Because we now have Sam Bankman-Fried of FTX thinking he can bail out the entire space, much as John Pierpont Morgan did in 1907. But where we ended up, of course, in 1907, only 6 years later.
I think it's interesting that everyone makes a parallel to 2008, because that's, you can argue some degree of recency bias, although it's not that long ago, right? Everyone always wants to make a parallel to something else that happened in market history in a crisis, but every crisis has its own unique dynamics. And you're right on the leverage point. I've made that argument many times, that there was a hell of a lot of shadow lending that people were not really aware of in the space. Now, the question becomes, what happens coming out of this, right? Because arguably, after a big crisis, people get afraid of re-leveraging because they've suffered severe losses due to that leveraging. I don't get that sense from the cryptocurrency community, though. How do you think about the state of leverage going forward? Do you think that this was enough to shake speculation, or is this only going to embolden investors?
Well, I don't think we've seen the last of this yet, because underpinning this reversal, and the reason why I said that, although we had a specific event that triggered the domino-like effects we've seen in the last couple of months, in fact, the market was already falling some time before that, because I think this is actually all linked to the pivot in traditional finance, and particularly in central banks, to a much tighter monetary paradigm in response to the return of inflation. Inflation was, originally, I always thought there would be some inflation as the pandemic retreated and economies started to reopen again, because demand would recover faster than supply. And no, that turned out to be the case. But then, of course, we had a war. And I don't think anybody had that on their bingo card particularly. And so inflation is now much higher than we expected, and is much more, seems to be much more entrenched than anybody expected. The predictions are not good. So what's happening now is that central banks around the world are combining, if you like, cooperating, or certainly acting in concert, probably more accurately, to tighten monetary policy. The effect of that is to withdraw liquidity from markets rapidly. So we've got this aggressive liquidity drain going on that is causing disruptions in traditional markets. And I think we're going to see more of those. But it also has a knock-on effect into crypto, because in the end, what underpins crypto is not Bitcoin. It's the US dollar and other major currencies such as the euro. When liquidity is drained from those, then that affects crypto. So I suspect we're going to see, I know that markets are rallying at the moment, but as you know, Michael, in a bear market, you do get temporary reverses when things look as if they're getting better again and the whole thing collapses again. So I think we are going to see further collapses. And I also think that there will be people who will think we're coming out of this and we can leverage up again and start being bullish. And some of those people might find themselves taking quite big losses.
All right, so let's talk about that liquidity point for a moment here, because what's happened with liquidity, I think, is far deeper than just what the Fed has done. I've argued for a while that really, I think a bear market started February of 2021. That's when a lot of global liquidity measures started turning. That's when breadth peaked. And that's around the time when the dollar started really beginning its massive run, to the point we've seen most recently at the highs against the euro. What do you think is the real cause of liquidity draining outside of the Fed? Because this has been one of those perplexing dynamics, which I don't think people really fully appreciate. As much as there was all these concerns about the Fed hiking rates maybe middle of last year, the reality is liquidity started draining out of the system way before that. And it's not clear to me what the source of that was.
It's not clear at all. It's interesting you say it's as far back as that, as February last year. But yes, we do seem to have had like a turn to fear, I suppose, for some reason. Almost like people saw something coming and they didn't know what it was. I had the sense last year that there was this immense feeling of some kind of sort of Damocles hanging over us that was going to fall any time now, and so you needed to shore up your liquidity and hold on tight to your assets now before the storm hit. It felt a bit like that. Whether the storm was in inflation we're in now, or whether it was actually, I don't know, some kind of zeitgeist anticipating a war, I don't know.
Yeah, it's just one of those strange dynamics. I just did a presentation in Sacramento, the CFA chapter, and an audience member had asked me, what do you think explains this dual sell-off in stocks and bonds? And I paused, saying, I don't believe it's just the Fed by itself. I think there are other factors at play, and it's not clear what those factors are. But to argue that this horrendous sell-off in bonds that really started with just a minimal amount of hiking of rates can be that's the reason, to me doesn't make much sense. But let's keep going with this point on liquidity. So there is this belief that liquidity means inflation.
Yeah.
I don't think it's as simple as that, but I'm curious to hear your thoughts on the interaction of inflation expectations and liquidity, because you've had inflation rising with arguably rather a liquid environment.
Yeah, I mean, I think it's very easy to look at kind of money supply, liquidity, and inflation as there being some kind of simple linear relationship between them. The more money you have in the system, the more liquidity there is, the higher inflation is going to be. It isn't really as simple as that, and it depends on many other things. So actually, over the last more than a decade, we have in general had ample liquidity in the system. I know we tightened a bit between 2018 through into 2019. Sort of September was really when the party ended and the Fed started injecting liquidity again. But in general, since the financial crisis of 2008, we've had a very ample liquidity environment in general, not least because governments were offsetting fiscal consolidation, both in the United States and in other places as well. And of course, we had the Eurozone crisis during that time, and a lot of countries in Europe are still with very high levels of government debt and a very tight fiscal position. So the ECB really picked up QE where the Fed left off. So the Fed ended QE, or signaled that it was ending QE, pretty much 2014, 2015, and that was roughly when the ECB started doing QE. So we've had continual QE. really from the end of 2008, beginning of 2009, through it's going on somewhere in the world, really through until now, when all of a sudden every central bank, I think except Japan, and Japan's wobbling, are saying, no, 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 QE is over. Now we're going on to quantitative tightening. At the same time as governments, which have been running extraordinarily loose fiscal policy during the pandemic, handing out money to their citizens, like it'll never run out, are suddenly turning around and saying, actually, we have got to pull back on all of this. We don't need it anymore. The pandemic is coming to an end. You lot can all stand on your own 2 feet again, your own money, and we're going to withdraw this support. So we've got concurrent fiscal and monetary tightening going on. I think that markets saw this coming and perhaps were quite surprised that it took as long as it did. And that might have been what sparked the start of the sell-off, Michael, because obviously if you've got an awful lot of countries with now extraordinarily high public debt because of the pandemic, and central banks are signalling that they're going to withdraw support for that, they're going to end QE and stop buying their own country's debt, then potentially you've got, in some countries, you've got the possibility of sovereign debt crises.
All right, so let's go with that, because I keep getting nervous about another 2011 repeat in terms of the return of the pigs, right? So none of the problems back then with the Eurozone were really ever fully addressed. The answer was just buy up all of those debts from sovereign entities that kept on widening and try and kick the can down the road. And as much as everyone rants against the Federal Reserve here in the U.S., I think the ECB has become much more of a problem than most realize in terms of their own policy response. Talk about the what do you think may be coming here with the Eurozone, and if we could see kind of this issue around the pigs come back into the headlines here?
Well, it's very interesting, isn't it, that when the pigs, as you call them, kind of the Eurozone crisis started, although it was Greece and Ireland that had got themselves into massive problems because of the financial crisis, really, the canary, if you like, was actually Italy. That was the point when the Eurozone started to look really unstable, was when there were all sorts of shenanigans around Italy's government, and people were beginning to get worried that Italy might default on its debt and leave the Eurozone. And we seem to be right back there again now. What is everybody talking about? We've got the Italian government has just resigned because Draghi, who's been the Prime Minister of Italy, was the ECB's chief, who said, we will do whatever it takes to keep the euro together. And the ECB has been following that path ever since. We will do whatever it takes to keep the euro together. And that means controlling the spread of a sovereign debt over bonds. And it has been doing that assiduously for a decade now. Draghi went on to become Prime Minister of Italy, and he has just resigned. And Italy is going to have new elections. And I think the dominant parties in the new elections might well be quite Eurosceptic ones like Lega. So again, we're beginning to see the real fear that was behind the whole pigs thing and then whatever it takes and so forth was that the Eurozone would break up. I think we're going to revisit that again now.
So that's actually a pretty big statement. And I don't necessarily disagree with that, right? Because this issue does have to be addressed, and it just seems to me that nobody's really talking about the risk that Europe becomes a problem child again, so to speak, for the global landscape. And your point about whatever it takes is valid. I think back then, I don't remember exactly how the euro was behaving, but now with the euro as weak as it is, it seems to me that you've got a real issue here where there might become a real question as to whether the euro can survive in the context of debt that's unresolved, in the context of very high inflation and a very non-unified Europe.
If I can just jump in there, it doesn't show itself in the euro's exchange rate. Back then, the euro's exchange rate, the euro itself looked stable. It wasn't crashing against other currencies. Where in a currency union like the EU, the strains show is in sovereign yields. So at the same time as the euro itself looked okay, various countries within the Eurozone, their bond yields were heading for the skies. Greece, most obviously, but also Italy, Spain, Portugal, Ireland, the pigs. That's what happened to them, was that there's bond spreads blew out. Now, ever since Draghi did whatever it takes, because the fear was that those countries would leave the euro, so the euro would break up. Now, it doesn't mean the end of the currency. It just means that the countries that are part of the currency would redenominate into other currencies. So Italy presumably would return to the lira, and Greece to the drachma, and so on. Redenomination risk, which is a kind of default. And that's why it shows itself in the bond yields rather than in the euros exchange rate. It's possible for the euro to survive that. The outlook is much less good for the countries concerned. Now, the problem, though, is that if Italy gets into trouble, it's such a big country and it's so indebted that actually the whole future of the Eurozone appears to be in question. And that was really why, back in 2012, Draghi did this off-the-cuff, whatever it takes remark. We will do whatever it takes to prevent the euro falling apart, which was essentially what he was saying. And believe me, it will be enough. And then off the back of that, we had a lot of work by the Commission and the Council of Europe to put in place fiscal rules to try and prevent countries flying apart from it, diverging too far fiscally. And so they kind of locked themselves into this straitjacket. But the straitjacket has been, in effect, taken off during the pandemic, with the ECB standing there buying all these bonds to make sure that spreads didn't blow out again. Now they've reached the end of the pandemic. They've got inflation rising. They need to tighten monetary policy. But how the heck are they going to do that while continuing to do whatever it takes to keep the euro together? In other words, to prevent bond spreads blowing out again like they did in 2011. That's the dilemma, I think, that faces the ECB.
So it's an interesting choice, right? Because if the argument is that they have to kill off inflation because of the energy crisis in Europe, then it's a choice between killing off inflation or a sovereign debt crisis. You can't have both.
Well, it's more even than that, because at least back in 2011, 2012, Germany had been hit by the financial crisis, and one way or another, it managed to get itself out of that, partly by dumping a lot of its banks' debts on other countries and then clamping down on other countries to make sure they got paid. But Germany did recover rather well and became and developed even more into an export powerhouse. Now, but this time, Germany is in big trouble, because Germany is one of the most exposed countries in Europe to Russia, and specifically dependence on Russian energy. If Russia turns off Nord Stream 1, Germany is into energy rationing. Now, that means potentially that the export powerhouse that has essentially kept the whole Eurozone economy alive for the last decade is likely to run out of steam.
And it sounds to me then that Germany's influence over what happens next is probably even greater than it was in 2011, right? Germany was very much pro-austerity, right? Kind of anti doing these policies by the ECB. And now the policies by the ECB combined with Russia, Ukraine, has kind of proven out that Germany may have been right all along, that austerity was the answer.
Well, I mean, Germany appears to be trying to do kind of the same that it did in 2011, 2012, only a bit more kind of explicitly, and with a lot of pushback from the other countries now, which is basically say, well, we've got to cut our gas usage, our natural gas usage by 15%, so you've all got to cut it too, to countries that don't use as much as it does and aren't as exposed to Russia. And they're going, well, why should we do that? And rightly pushing back to Spain and Italy, rightly saying, well, you wouldn't share in our debt problems back in 2011, 2012, so why should we share in your problems now? So actually, there's quite a lot of political strains within the Eurozone being caused by, if you like, the history, the memory of what happened in the Eurozone crisis, when when the peaks really took on very hefty slugs of austerity, because the likes of Germany wouldn't share in their debt burdens. Now pushing back and saying, we don't really see why we should help you out of your difficulties over your exposure to Russian gas.
Yeah, I think this is going to be an interesting dynamic in the next several months, because this is something I don't hear many people talking about. But let's pivot that a little bit more towards the inflation entrenchment point that you made earlier. The problem that I've always had with all this discussion around inflation and the word transitory is that nobody ever defined what transitory actually meant. Right? Everyone always said, right, the Fed said inflation is transitory, and then everyone's like, oh, it's not transitory. And then it's like, well, hold on. Well, transitory could be 3 years. actually, in the context of long cycles, right? I mean, temporary needs to have a time frame. Nobody ever defined what the time frame is. Now, I happen to be of the personal opinion that I do think inflation is transitory, but on a longer time frame than what the media, I think, was implying all along here. But if inflation is entrenched, meaning if it is not transitory, if it is a secular, longer term dynamic, how do you think society will take to that from a long term perspective? Because when you've got this huge wealth gap, you've got a lot of people struggling to pay for basic needs already. It seems to me that inflation has to be transitory because governments being in power will be transitory if it's not.
Yeah, this is an interesting question, the whole team transitory thing, because the team transitory were people like me who said there will be some inflation as the pandemic retreats and economies reopen because the supply side's damaged. Lots of companies have gone out of business. We've got supply chain disruption. The supply chain will be weakened, and we have supported demand throughout. Demand will recover faster than supply, so there will be inflation. And so when inflation happened, we were all going, yeah, okay, we were expecting this. And it'll be short-lived because it's supply-side driven. As the supply side recovers, inflation should moderate. That doesn't mean that prices will come down. It just means that prices will not rise as much. I think people don't always understand this, that inflation moderating does not mean prices fall. It just means that they don't rise as much. When prices fall, that's deflation. And it's possible we might see that at some time in the future, but it's difficult to predict when. So the question about how long is transitory depends upon things like the fact that inflation is an annualized phenomenon. So if you're looking at year-on-year inflation, then your transitory is at least a year. For example, if you've had cuts in sales taxes, for example, to support the economy, they can take a year to work through. And so you're going to see that reduces your inflation rate for a year because it takes that long to work through. So to say on team transitory that you must be coming out of inflation within 3 to 6 months is not reasonable because it's not how inflation works. I took transitory to mean 1 to 2 years, and we're still within that time period. But what none of us had on our bingo cards was a war. All of us expected that, well, I certainly expected, lots of people expected that one of the areas where we would see price rises, rapid price rises in the wake of the pandemic was in energy, because back in 2020, prices actually fell. The oil price fell, the price of gas fell, prices at the pumps fell, energy prices fell. Here in the UK, where I am, in 2020, the price of what we call petrol, and in the United States you call gasoline, at the pumps fell below £1 per litre for the first time since the early 2000s. Nobody noticed because we were all stuck in our homes, not allowed to travel anywhere, and that's why the price had fallen, was nobody was buying it. But that means that when everybody starts moving again, when they're allowed to buy fuel, when demand for fossil fuels rises again, then the price rises rapidly, and that looks like inflation, but it's what we call base effects, is sort of the rebound from an earlier sharp fall. And part of what's happening with inflation is base effects. And again, those can take time to work through. The problem is that energy prices, particularly oil, gas, and also foodstuffs and other global commodities, have overshot considerably from their falls during the pandemic. And the price rises have continued for longer than we might have expected. Simply.
All right. So now on that discussion, let's get into some of these. Let's call them crazy. Oh, sorry.
Yeah. So from on those grounds alone, I would expect, since oil and gas, fossil fuels are still so incredibly important to Western economies. Lots of us are major importers. Because of that, inflation in the Western world is going to be entrenched simply on those grounds alone. It's not the only story by any means, but it's an important part of it.
Yeah, I apologize. I had somebody, my phone was tripping out there for a second. Okay, so let's get into a little bit of these, let's call them wonky ideas. So I named the space, cutting taxes could stop inflation, which sounds like a crazy idea and very much counter to the MMT argument around the way to control inflation if you have modern monetary theory and practice, which you can debate. We probably have some strange hybrid of. But let's talk about this. Let's do a little thought experiment around the role of taxes and inflation. First of all, is there anything that you've seen, Francis, in your work that suggests that there is a link between inflation changes or disinflation fears and tax policy?
Generally speaking, most people assume that cutting taxes is inflationary. And the reason for that is that when you cut taxes, people have more money to spend, and businesses have more money to invest, and so you are fueling demand in the economy, and that's where your inflation comes. If you've got a weakened supply side already, and people have already got quite a bit of money to spend because they stored up lots of the money they were given during the pandemic and didn't spend it, and now they're spending it all in a big hurry, then cutting taxes on top of that can actually fuel inflation in the short term. I don't know that too many people would disagree with that, really. It's more the medium-term effect of cutting taxes, particularly cutting business taxes. There's a view going around, expressed by some fairly outliers in the economics profession, I would say, that in the medium term, cutting business taxes can reduce inflation. And the reason for that is that if you cut business taxes, then you give businesses more money to invest. They can invest in plant, they can hire more people, and they can produce more. Now, if you regard inflation as an imbalance between the demand for goods and services and the ability of a weakened supply side to produce them, then what you need to be doing is something to help and encourage the supply side to produce more. And cutting taxes potentially is one way of doing that. So that's the argument, that if you cut business taxes, then businesses can invest more and the supply side will grow, and then it will catch up with demand and inflation will moderate. That's the argument. I think it's quite a simplistic one, though, because what it ignores is the fact that these days we task central banks with controlling inflation, and we gave them their independence so that they could. If you cut taxes sufficiently to make that kind of difference to aggregate demand, because business investment is part of aggregate demand, then you force central banks, because it's inflationary in the short term, you do really force central banks to tighten monetary policy faster. Now that squeezes the parts of the economy that aren't having tax cuts, particularly households, and so they will cut spending. And that is going to depress business investment, because businesses won't invest if they see their sales outlook worsening, because people are cutting spending because because their mortgages are suddenly much more expensive and their credit cards are heading for the skies. So it's a little bit of a risky strategy when you've already got inflation to try and get rid of it by incentivizing the supply side to grow. Is a little bit of a risky strategy. That's not to say it can't work, but you really have to hold your nerve through the short-term inflation, let central banks do their job, and maybe on the fiscal side provide some support to the people who are going to be hurt by a faster tightening of monetary policy.
All right, so I had this discussion with Mike Green either last weekend or the weekend before. It's all quite fuzzy at this point, but it was along the lines of this idea that in order to increase supply, you have to increase competition, right? Mm-hmm. And that's the only way that competition solves any kind of supply chain crisis. I mean, you can argue that one of the main reasons that you had this fear over baby formula shortages in the U.S. is because there are only 4 companies that supply baby formula in the U.S., and that wouldn't be the case if you had more competition. So let's talk about that for a moment here, because I think this is a broader macro issue which has been, I think, accelerating over time, which is that increasingly industries become more and more concentrated with just a couple of dominant players, and they really control everything, right? And that's not just a US-based phenomenon, that's a global one, I would argue, sort of this winner-take-all effect that's beyond technology. How do you think about policies to help increase competition when every time we see some new company pop up that seems to be a competitive threat, suddenly they seem to be bought out conveniently by bigger players?
Well, actually, it's one of these areas where I think free market theory actually fails, because the natural tendency of unregulated markets is towards oligopoly or monopoly. And so historically in the United States, we've always had antitrust. There's always been antitrust legislation, which is designed to prevent markets being dominated by one or a small number of firms. And we have similar kinds of legislation in the UK. intended to ensure that there is competition within markets and to prevent mergers and acquisitions when the effect of that would be to over-concentrate the market. In this country, the Competition Authority can simply refuse to allow a merger to go ahead if the result is that the whole market will be dominated by like two firms. I mean, it seems to me that our antitrust legislation is not working as well as it might, because despite that, we are still having these markets which are dominated by a very small number of players. And sometimes the arguments that are used to justify a merger or an acquisition going ahead, despite the fact that it appears to create a near monopoly, look at the global marketplace rather than the domestic one and say, well, there are all these players globally, and we need to be big to compete with them. So obviously it's absolutely fine to have only one company in this country doing it. Well, that's fine, I guess, in a completely open global marketplace. But that's not what we have. And in fact, one of the drivers of current inflation, which I don't think gets talked about enough, is the fact that since about 2016, really, we have seen considerable increase in barriers to trade, really. That the period of that we call the Great Moderation, which has appeared from about 1992 through to the financial crisis, and then the Great Stagnation after that, is also the greatest period in recorded history of global free trade. It's much, much better than the period that everybody always cites, which is the classical gold standard of the 19th century. We've actually got fewer barriers to trade now than they had then. We had, and particularly since 2000 when China joined the World Trade Organization, suddenly we had these open borders, we had free movement of capital, we had companies able to operate anywhere in the world. And we could treat it as a global marketplace, and goods and capital and people could move freely. And that's actually what's been moderating inflation all of that time, in my view. Now, as we've been progressively putting in barriers to trade, shortening supply chains, trying to reshore, trying to bring back domestic production, we're bringing back the potential for there to be domestic inflation, because we've got sand in the wheels, if you like, that's preventing this kind of, that's closing down or restricting this open, globalized free market that really has been keeping inflation under control. And if I'm right about that, then I think we are seeing entrenched inflation. And this is where the zeitgeist is, where the politics is going. If you think about a lot of the political movements, really since about 2015, 2016, has been about trade wars and currency wars as well, and putting up barriers to trade.
Yeah, I think this is sort of the interesting dilemma with the Fed here, which is that if they're going to keep on increasing the cost of capital, well, a higher cost of capital makes it harder for new entrants and industries to pop up to then provide that competition. Sort of a different spin on cutting taxes could stop inflation. You could also make a very odd argument that keeping rates lower might increase competition with a little bit of government nudging in terms of policies, and that would be ultimately the solution to supply chain disruptions. But it's hard to envision a call for the Fed to lower rates to try to stop inflation.
And I think also it's not the Fed's job. The Fed's job is to control inflation and ensure full employment. That's the Fed's mandate. It's a dual mandate. Some central banks don't even have the dual mandate. The ECB only has the mandate for price stability, and UK's central bank, really it's a price stability mandate as well, with a secondary objective. It's supposed to support the government's economic policies, whatever they are. So to say, the Fed must foster competition by keeping rates low, actually is interference with the Fed's mandate. It's not its job. This is arguably the job of fiscal policy. So you could use tax policy that way. You could say, right, the Fed needs to raise interest rates because we've got entrenched inflation. It is at least partly domestic. It's the consequence of the CARES Act, when we threw loads of money at people who couldn't spend it, and it's the consequence of reshoring and putting up barriers to trade and all these other things that I've mentioned, plus the energy shock on top of it and all manner of things. And maybe we're going to have to live with higher inflation for longer, and the Fed's job is to bring that down to target over the medium term, and the Fed needs to have the freedom to do that. And if that means raising interest rates by very much more, then the Fed needs to have the freedom to do that and not be hampered by considerations of, oh, but we need to encourage competition. It's actually the government's job. So this is a case where you use tax policy. So you do things like providing tax incentives for startups and small businesses to help them to compete against the incumbents. You introduce more effective antitrust legislation so that they can't be taken over by incumbents before they even get going. This kind of thing. And I don't think government should be ducking that responsibility. I think it's a key part of a government's job is to actually create the regulatory, the legal and regulatory environment in which competition can flourish.
So the question is, why don't they? I mean, because it seems so obvious, right? It's not just, again, a U.S. argument. I mean, every country should be doing this, and you think that's actually good politically and for the existing parties to remain in power to encourage that. But it seems to me that either there's lobbyists or other factors in the background that just prevent any of that from becoming a main part of any discussion around how to handle economic issues.
Yeah, that's exactly what happens. So there's a huge amount of money in the lobbying industry, and there's an awful lot of politicians who are very rich because of it. And it's in their interests to foster the interests of big businesses that are donating to their campaigns, to their political careers, and not in their interests to introduce and push through legislation that hampers those big businesses. I'm sorry to be cynical, but that happens in every country on earth, to a greater or less extent. But that kind of politicians serving the interests of big business, it does seem to be endemic, and I'm not sure what you do about it. So I say it should be the job of government to foster good competition. But while you've got these kind of lobbying and politicians in the pockets of big businesses and these immensely expensive campaigns, political campaigns that are essentially funded by big businesses, I honestly don't see how you have that.
Yeah, no, I agree. And this is one of those dilemmas, I think, from a longer term perspective, that it's just hard to counter all this entrenchment of all these different players like that are just impacting policies in a wrong way. All right, so let's go back a little bit here to the Federal Reserve and quantitative easing and, more importantly, quantitative tightening. I am personally not of the opinion that the Fed will ever be able to get out of the balance sheet expansion game, only because, to the earlier point around leverage, QE causes an increase in leverage. Leverage is the necessary precursor for crashes. Every single response by the Federal Reserve to a crash is to re-leverage, which means there's more fragility for the next crash, which is why we keep having these cycles of shorter and shorter time frames between tail events. And the argument there that I'm making essentially is that you can't really fully get out of quantitative easing, because the assumption is that you have enough time to do so before another crisis manifests. So let's talk about your view here, Francis, around if the Fed can ever get out of this QE game that they started, post GFC.
Well, they can. The question is for how long they can. I think what's not going to happen is any return to the pre-2008 monetary paradigm where we had a relatively small Fed balance sheet, reserve scarcity, and controlling policy through the Fed funds rate, and what we call a corridor system. I don't think we're going to go back to that. We've had this ample liquidity environment, excess QE, excess reserves for banks paradigm for so long now, and remunerated reserves and relying on the interest on reserves rate to direct policy, to influence the Fed funds rate, which is how we've been operating now, really since 2008, 2009. And that's a long time in markets. So it would be actually very difficult to change it now. So I think it's more a question of saying we're going to have to live with that. And that implies that the Fed is going to have a historically large balance sheet indefinitely. That doesn't mean it can't reduce it somewhat. I mean, it did reduce it quite considerably between 2017 and 2018. But of course, it's whacked it all back up again now, and we're in the pandemic. But it became apparent in September 2019 that the markets actually couldn't cope with quantitative tightening if it went on for too long and did too much, because we then ended up with liquidity strains in the repo market. We ended up with 4 big banks hoarding reserves because they were getting sudden big demands for payments all at once, and that was pulling liquidity from the markets, and repos were blowing out, and so the Fed intervened. And I know the Fed didn't formally restart QE until March 2020, but it had been injecting liquidity into the markets in huge amounts for more than 6 months before that. And it may be that, the Fed does act as dealer of last resort in markets. And while markets need liquidity and, repo rates blow out and so forth, if it doesn't have enough, then we're going to see the Fed continue to intervene in markets in some way. It won't be called QE. It'll be called something else. The ability of central banks to invent terminology that makes them look like they're doing something different when they're actually doing the same thing really is legendary. I mean, thinking of the ECB's use of long-term repo operations, which actually, when you dissect them, are not that dissimilar from QE really, or during the pandemic, their pandemic bond purchase program, which somehow wasn't QE either, and that enabled them to buy Greek bonds, which were excluded from QE. It's all kind of Jedi mind tricks, really. The imperative is actually that central banks operate too, because it's the only way they can control interest rates is to control liquidity in markets. If you think about it, Michael, that is how central banks control interest rates, is through controlling liquidity in markets.
And the problem, I think, longer term from that perspective is that you'll never have any kind of fiscal cleanup of all of the spending, because you can't have QE unless the government is issuing enough treasuries for the Fed to buy, which means that you end up having ongoing overspending by governments, and that presents its own distortions longer term.
Well, that's an interesting question in itself, because, of course, in Europe, the ECB, one of the difficulties the ECB got itself into before the pandemic was that, the primary safe assets that the ECB liked to buy as part of its QE program was bonds. And the German government is kind of famously frugal, has this balanced book requirement, and a debt break. So it actually couldn't issue enough to meet the needs of both the markets and the ECB. And this was the reason why market rates for German bonds were so persistently negative for all the way along the curve. They were negative right out to 30 years. And that was why, because there just weren't enough of them. So actually what happens if you don't have enough debt issuance by governments to meet the needs of central banks that are actively doing QE, and markets where you've got institutions that are required to hold government debt for various purposes, like banks, and in order to obtain funding need because government debt is safe collateral in funding markets, and pension funds and asset managers using it as for hedging and this kind of stuff. And there's lots of people who need to hold government debt for a lot of reasons. When you've got a lot of institutions and central banks competing for a shrinking pool of government debt, then what happens is your yields crash, and they can end up being negative. So, and that, of course, from a central bank's point of view, causes problems. If the central bank wants to raise rates, but there's so little government debt in circulation that yields are crashing, then how do they square that one? That could be interesting to see too.
Yeah, it's a bit of a strange paradox, right? Because it's like I put out this sarcastic tweet yesterday saying, "Don't worry, inflation is being caused by supply chain disruptions, not $30 trillion of government spending in the U.S." But you can make an argument that if the government doesn't spend more, the Fed can't be effective on QE, because to that very point, it actually creates distortions because the supply of treasuries is shrinking. But that creates obviously all kinds of other problems for this inflation disinflation debate. So you never really have a free market.
Though we should remember that aggressive quantitative tightening returns treasuries to the market. Passive doesn't, where the kind of quantitative tightening the Fed did in 2017 to 2018, when they simply allowed treasuries to mature. They rolled off, but they didn't refinance them, didn't buy any more to replace them. So their holdings gradually shrank. But if they're doing aggressive quantitative tightening, then they would be actually returning treasuries to the market. They would be selling them or lending them out one way or another. And we do have the reverse repo operation, which effectively returns treasuries to the market, if you think about it. So the Fed's got this kind of pump thing going on, whereby it's got standing repo facility for banks, whereby they can come along and help pledge some collateral and help themselves to funds. And at the other side of that, they've got the reverse repo facility, whereby non-banks can come along and deposit some money and take out some treasuries. So using those two facilities, they can control, kind of balance the quantity of two different types of liquidity, one being reserves or cash, if you prefer, and the other being short-term treasuries, T-bills. Okay, and we should remember that in markets that these two forms of liquidity exist. It's not just simply a question of liquidity is cash and everything else is various forms of asset. Short-term treasuries are another form of liquidity, and as important as reserves.
Yeah, no, I think that's an interesting point. All right, so listen, everybody that's here, please make sure you follow Francis here. Also has a very interesting book called The Case for People's QE, which I encourage you to take a look. It's available on Amazon. Francis, first time you and I are doing this space. A very interesting conversation. Thank you for joining. I appreciate it.